spreadbet.com. My name is Stu Wisson. In this article I'm going to be discussing about the stock market. Now we've all heard of the stock market. In fact, on the news we can't escape it. Daily we are shown values. The FTSE falls 3%, the New York Stock Exchange falls by 2%, and so on. That to many probably don't mean a great deal, but in actual fact do reflect the current state of business of a country as a whole in broad but not so accurate barometer, as you will learn more about later. So what then is the stock market? Well, first of all, the stock market also means the equity market too. Both are one and the same thing. Essentially, the equity or stock market, take your pick, is in fact a real public entity consisting of somewhat loose economic network for transactions of physical stock, equity, in a public listed or incorporated company. An open market for the sale or purchase of stock in household companies such as Apple, Microsoft, Google, Tesco, Sainsbury's, Exxon, and more. The stock is a share of a company which has limited shares to sell. Now, the demand for a stock based on the expectation of a company's current and continued success or failure drives the value, or more to the point, partly perceived value for the stock of that company. Now, the sole and primary aim of any stock market is to bring together buyers and sellers that trade between themselves for the given stock in their market. For example, those trading on the trading floor in the London Stock Exchange will primarily be trading UK-based stocks. Those trading in the New York Stock Exchange will be trading mostly US-based stocks. However, it doesn't mean that a trader in London can't buy or sell stock from the US market or vice versa. More so, there are primarily stock markets, based in every main city around the world, because each country has public listed companies where there is a demand for the sale or purchase of that company's stock. Now, one key point to understand about the stock market is that these days it is not just for the sale of company stock in the terms of true exchange. Yes, this was and still is the primary aim, to provide a central location for the sale and or purchase of company stock. However, over the last few decades, and in fact more so in the last 15 years or so, there's been an incredible rise in the use of derivatives, which were also traded in the same markets. Now, derivatives are a means of creating a financial product, a vehicle, based on a true actual product, which is known as the underlying. Now, look at it this way. A derivative, for instance, could be based on the FTSE 100, Financial Times Stock Exchange Top 100 Companies, which is an index, either being above the previous day or high or not. Therefore, traders would trade, or essentially gamble, whether the market was higher or lower than the previous day. The actual product they trade is the derivative. It's derived from the value of the FTSE 100. But unlike the equity market, it actually holds no true intrinsic value. The trade is based on a notional value that either has a true or a false result, nothing more. Now, this is an example, a quick one, of what a derivative is. There are many, many more. In fact, as an aside, it was the derivative markets in the subprime mortgage sector in the US that began the decline in the financial sector in 2009 onwards. The London Stock Exchange trades between 8 a.m. and 4:30 p.m, with the final end-of-day price of all stocks taken at around about 4:35 p.m, to allow for the final amount of trades to trickle in and be accounted. Now, those trading the markets, that is known as a whole, are retail investors, the general public, you and me, institutional investors that manage anything from banking, hedge funds and insurance, and many pension funds are managed and traded in and out regularly at the stock market. Now, even companies will either purchase its own stock or that of other companies to take advantage of tax breaks and financial reserves that it may hold. For example, we have seen many times Apple purchase its own stock back with its cash reserves, or purchase stock of other companies with a view of taking a strategic market share of that company. Now, the stock exchanges around the world are traded much the same. In fact, all are computerized these days, such as the volume of trades and the speed of trading that is undertaken. Yet even today in some of the markets you will still see some traders adopting the old method of buying and selling, known as open outcry. Now this may not mean anything to you, but I'm sure you've seen it on TV and in films, and it's one of the most mimicked gestures when anyone hears the word stockbroker. You guessed it, it's the hand signals given across the trading floor to broker sales of stock. Now the method of sale or purchase of stock is based on the auction model. Now this is what drives the market for the stocks up or down. For example, we have company XYZ, for example, and the broker has a given amount of stock for sale, and he knows that the current market for that stock, say, is trading at 100. Yet he knows that demand for that stock is likely to be increased based on any number of factors, from expected profit announcements that it's expected to be positive, to news on the development that the company is involved in, or simply the stock is trending on the open market based on market psychology being positive for that stock. Now, I'll be talking more about market psychology and what really drives the markets in the training course, which is free on this website, which is being released very soon. Now, as the broker knows there is a demand for the stock, he could wait and demand a higher price as the amount of available stock for the sale in that company starts to dry up, or he could sell his stocks now. Therefore, he could ask for 110 for his stock and wait to see who will be buying at that price. If he gets a good amount of sales, he may start to raise the price quickly. At the same time, there are other traders, brokers, selling and buying the same stock. It is this natural flow of bidding and asking for prices that creates the market. Now, as I've said previously, I will explain later how the actual market is based on market psychology rather than any given physical value. Why then does the market exist? Well, aside from the whole speculation of markets and its derivatives, which really came much later, the whole purpose of the stock market, and still is as a means for companies to sell stock in itself to raise money for investing back into developing the business. Another example will help here. Any business can become, in our example, a PLC, public limited company, if you're a UK-based company, by selling its stock on the open market. Now, there is a great deal of legal and financial work involved to start what is called an IPO, an initial public offering, which is when the stock is initially auctioned off to raise funds for the company in question. A good example of this is how it can raise a great deal of money based on expectation and market psychology, is that of what was known as the tech bubble or internet bubble of the very late 90s, early noughties. The internet was pretty new to most people at that time, and it became very much like the Wild West again. In fact, personally, I have a lot of experience, as during that time I was both a project manager and internet manager for 2 startup companies and an internet service provider company. To see the amount of money pouring in and out of these companies, of these pie-in-the-sky ventures sometimes, was incredible. Many internet companies sprang out of nowhere. They would start up on a shoestring and then go IPO as soon as possible to raise money, simply just purely based on an idea. Some of the ideas back then were ridiculous, but because the market was naive and it was seen as a means of speculating, and many of the stocks were rising in value way beyond that of any true value, again, market psychology in action there. The demand for new IPOs and stocks became huge. These new internet companies were raising millions upon millions, yet they hadn't even before they had gone IPO, made a single penny. Yet the demand for their stock grew and grew. However, it was only a matter of time before key investors started to look deeper on their earnings reports that brought in no relation to the promises made on the IPO brochure. Within a few short months, stocks in these companies crashed. New IPOs were having problems raising money, and eventually for years to come, any internet-based IPO had trouble raising even the opportunity to sell. Now, this is a good example of how actual price of stock bears little to no real market value of that company. It is essentially what other people believe that the stock is worth and no more, based on the auction of that stock in a stock exchange. Even recently, we have seen market crashes led by the financial sector. This, though, was different in that what was led by the oversale of subprime mortgages, basically the sale of a mortgage and loan to people that had no means of paying them, to which the broker received a commission based on the sales, and the derivatives of that market were incredibly popular, and they climbed in value so incredibly quickly. Strangely, no one questioned what would happen if these subprime buyers couldn't pay. Banks and other institutions jumped on board, could see huge speculative profits in the sale of these loans and the ever-increasing derivatives based on them. This spiraled out of control till one day, not so far down the line, people started to default on their loans. The banks were overexposed, which became known as toxic debt. Banks collapsed, financial institutions failed, and the whole thing started what became the biggest financial collapse since 1929. In many respects, it was bigger, but the reaction by governments was much swifter, by bailing out the banks, and personally, I think it was a big mistake, something which I'll be talking about later in the free course. As we will see, the stock market is a means for companies to raise money, for those involved in the market to speculate and potentially profit from the sale or purchase of stock, or the trading of derivatives in the market. It can show that real physical value of a company is rarely represented in the stock price, and how that expectation can lead to catastrophic gains and subsequent losses, plus how even the banks that we love or loathe can in fact cause market collapses in the stock market and other markets related to the banking sector, and how that has cost every man and woman thousands of pounds in taxpayers' money per person to bail out the banks and institutions.